It's fascinating, a bit painful depending on which side of the aisle you're on, I suppose, to look at the flow-on effects of this FX story, right? You're seeing it in dollar-yen today. You're even seeing it in some of these risk currencies like the Aussie. Is there further pain for the euro to go, given that we have had positioning turn to negative, right, for the first time this year? At the start of this year, it was almost a one-way bet to go long euro.
Yeah, look, we believe that there actually is further pain to go. I guess we're coming into a period now where there is vast uncertainty heading into what looks like further elections come September, or certainly after August. And we know that spreads in the Italian bond market have been moving higher quite rapidly. But this all comes at a time when European data had been a lot weaker anyway, certainly in terms of the surprise data and this discussion of globally synchronised growth, which was a very popular narrative towards the end of last year, has really decoupled over 2018, and European data has been somewhat disappointing. Now that we have these uncertainties on the horizon and it's dragging in some of the other peripheral sovereigns, we see deterioration in Spanish spreads and the like. Clearly, there is a little bit to worry about here, and I think the euro can continue to suffer. We have an ultimate kind of target of around about 112. The actual technical level is down at 111.87, but certainly it does look like there could be further, weakness to the downside.
Does this breathe new life into the dollar, Ali?
Yeah, look, I think it does. I mean, we've been pretty supportive of the dollar since the start of the year, when it did have that kind of chaotic sell-off after the tax legislation was passed, and we had a period of weaker dollar high yields as the markets recalibrated to a much larger fiscal spend from the United States. I think these short-dated US Treasury yields are really catching investors' attention at a time when there are some spot fires around the globe. We're seeing some issues which have calmed down somewhat in the last few sessions in emerging markets, some of which are absolutely of their own making, but others not. I guess Turkey and the like. But there's been Argentina, some issues in Indonesia. Now we have Italy joining some of those small spot fires. We still think that 2.5% yielding short-dated US bonds are very attractive, particularly at a time when the Federal Reserve have told us last week via the minutes that they're happy with some symmetry around the inflation target, and they're in no want and need to accelerate their hiking program. Those front-end yields are very, very attractive in a global context, and at a time where we've got some of this geopolitical tension and some of this slight credit delinquency, we still believe that the dollar rally has legs.
Charlie, I'm going to bring up another chart from our GTV library. It's showing what Heidi referred to at the beginning is how we've got all these short positions coming into place in the beginning of this year. The positioning here has turned negative against the euro. So my question would be, where is the money then going if it's coming out of the euro? Obviously, it's going to the dollar. And is that the reason why we are seeing the yields going down there as the prices of bonds go up? Because it doesn't seem to make any sense. The prices should be going down further if the money's going into the dollar. So where is the money going?
Look, I still think there is, some money flowing towards yen. Clearly, as funding kind of currencies are unwound, and those flight to quality currencies are doing very well. As much as the dollar has been appreciating in this rally, the yen has been keeping up. So that cross has been doing pretty well, and as we touched on briefly, below 109. But I do think that, treasuries do look very attractive, and certainly there is a lot of capital that will flow into that complex, given that the yields there are, really quite attractive. The euro, the ECB look quite particularly, they're in a tough spot right now given the economic data momentum that they are witnessing, the lack of inflationary impulse, and now some additional, political instability. Italy really matters. It's the third largest economy in the Eurozone. And to get this kind of narrative, out of the domestic political landscape, clearly that's going to be a concern for the ECB, and it looks like they're not going to be able to complete on any of their, normalisation or any steps towards that normalisation program. And that takes some of the lustre away from the euro. So I do think that we'll continue to see people move out of the euro and look to some of these, higher flight to quality type instruments that do provide, very good carry, particularly through this European North American summer period.